Welcome back. So today we'll be talking about F3, Chapter 2. So, alright, so as I promised, these are the answers to the first chapter questions that we did. The first topic, of course, is answer D. The second question, of course, is answer C. I don't think I really need to explain these topics because it's fairly simple and they're easy. It will be an insult to you as well as for me to explain these. So having said that, I'll be moving forward to Chapter 2, Financial Statements. Amazing topic. Is a very small chapter, so I don't think I'll be spending a lot of time on it. I will be covering, we'll be looking at what a statement of financial position looks like, statement of profit and loss looks like, an accounting equation, fundamental accounting assumptions. And then we'll have a few questions. They are going to be a little tricky for you, but since it's your first time doing F3, I think it's going to be very easy. And if it's your second time, it's going to be a lot more easier as well. So yeah, moving on. So I think that's covered. Yep. Okay, this is perfect. What is a statement of profit and loss? A statement of profit and loss, previously known as income statement, and some people call it statement of comprehensive income as well, is typically just a statement which represents the income and expenses of the company throughout the year, throughout the 12-month accounting period. So there's this format right in front of you that explains what exactly this is. For example, you have statement of profit and loss for the year ending 31st December 2012. You have a revenue on the credit side. Is it on the credit side? Yes, it's on the credit side. Then you have your opening inventory, you have purchases, you have stuff like that. Then you come to a gross profit. Now this is important. Okay, sorry, that was bad. This is important. Why? Revenue is the money that you earn from the company. Simple. You might have some inventory, you sell some stuff that involves inventory, you're doing some manufacturing work, you're doing some certain work that is involving inventory. So having an inventory is not necessary. You don't need to have inventory. Sometimes you can have it, most of the time you can't even have it. It doesn't matter, okay? You have a lot of purchases. Now what are purchases? Why don't we take all of this and put it over here? We can't. Why? Because purchases are those items that we buy directly in regards to earning this money. For example, you sell chocolates. Now you buy cocoa. You buy a lot of different types of cocoa and a lot of different types of sugar and stuff like that. Whatever can give your customers diabetes and make them fat. That too. So whatever. Now what are you doing? You're selling chocolates. What are the purchases for? The inventory of the chocolates. Maybe you do some, I don't know, packaging of the chocolate. You can't just sell your chocolate naked, can you? No, that's not going to work out. You have to sell it in a pack. So making it in a pack, that requires a small amount of work, and the work is here. Whatever you do you have to earn money, you have to put it over here. Understand? Moving forward, you have a few other things that you need to take care of. What other income is? Other income could be any income that's not related to your business. This most of the time is considered interest income. Something, the interest you earn from a bank for the money that you've kept inside, right? Simple as that. It won't be this much. It will be only a few bucks, but you know, something is better than nothing. And then you have some discount allowed. So this is a discount given from your purchases. Discount received is basically whatever you receive by buying some bulk things or maybe paying early, you know, whatever. You'll study more of these things in F9, so I'm just not going to touch over there. Maybe later, maybe in a couple of years I'll be teaching F9, so then we'll talk about it. You have depreciation on your fixed assets or your property, plant, and equipment that you modern people call it. And some other stuff that you need to take care of to earn the money. And at the end of the year, you have the profit. Okay, moving on. Okay, this might be a little bigger than I anticipated, but yeah, I think, okay, this is bad. This is, okay, perfect. This is cool. Statement of financial position, one of my favorites. One of my very favorites because it's fun to do. And okay, they're missing a line over here. That's so funny. Awesome. But anyway, we don't care about that now, do we? Or maybe they're not missing a line. They did it on purpose. You see, they did it on purpose over here, and at the end they put it here. So that's cool. That's cool. Anyway, that's not a point. That's not what we're looking forward to. We're looking at statement of financial position. Okay, that didn't work. Statement of financial position. You have your non-current assets, your property, plant, and equipment, and property, plant, and equipment. That's ironic. And then you have some of your motor vehicle. Could be anything. Could be anything that you're doing on a long-term basis. Could be literally anything. You can put it over here. Anything that's your asset that you're not going to sell. Any asset that you're not going to sell. Can't be your perfume. That's too petty. But can be your mobile phone. Can be your telephones that you put in your office. Can be the carpet you put in your office. But carpets, I don't think so. No, carpets won't apply. You'll read more about this in IAS 16, property, plant, and equipment, and stuff like that. I mean, that the name of the standard is IAS 16, property, plant, and equipment. And stuff like that is whatever I said myself. So that's not the name of the standard, of course. So you have the cost, you take your accumulated cost, and you have a carrying value. Accumulated cost will definitely include this year's depreciation, including whatever was pending from last year. Moving on to current assets, you have inventory, you have trade receivables, you have prepayments is the money that you pay in advance, of course. Cash at bank, all the money that you receive, and because of this, you earn some of your interest income up there. You have your capital. Most of the time in the exam, it will be a neat, small, rounded off figure, maybe 10,000, 50,000, 100,000. Over here, it looks nasty. You have some of your profit. Okay, I'll show you this. 51787, if the question is connected, it will be the same. Yep, it's the same. You see? So this figure goes here. Drawings could be literally whatever money you took out. You need some money and you took out from the company. Simple. And you have a loan you took. No. There's trade payables. Accruals could be anything that you. Okay, electricity, for example. What is accruals? Whatever you took care of. You're doing something, but you pay it for it later. Rent. Accruals. Audit fee. That's the most funny thing. You do the audit first, then later you take the money, right? A lot of things happen like that. Whatever you don't credit, whatever you don't have to pay on the spot or pay on early, that's accrual. Understand? The statement changes equity. Okay, fine. Okay, these will be covered in chapter 14 and 16. So okay. These do not matter. That's okay. Right. Moving on. We have the accounting equation, one of my favorites because it's easy, plus it looks cool. What's this? Assets. Asset equals to capital plus liabilities, or assets plus liability. Assets minus liabilities equals to equity, or assets minus capital equals to liability. Now this can shuffle up. It could be anything like asset equals to capital plus. This is a very basic concept that we write on. This part might just be a little bit important for the exam. Just a little bit, right? So yeah, read through this and you might have some questions. For example, you have a question over here. Show the accounting equation for Terry at the end of the week. Now this will equal up. This will tally up. If you're taking assets, the capital plus liabilities needs to be the same. Why? Look at here. Your total assets, and your capital plus liabilities are the same. They will always be the same. They're the same. That's the reason your financial position or your balance sheet, the old people used to call it, is the same. So I'll give you the answer next week on this matter, or maybe later this week. I don't know, whenever I record the next audio of the lecture. It's not an audio, but okay. Moving on, that we have some very important assumptions. Now these are important. You need to remember these for the rest of your life. This will be useful for you in F7, in P2, in P4, in P7, in your real life when you start working. Remember this for the rest of your life. Now, when I say remember it, I don't want you to remember the definitions of this. I want you to remember the concept. And when I say concept, it means if I wake you up at 3 in the morning, I put water at your face and I say, wake up, you idiot, and tell me what going concern means. You need to tell me what it means. You don't have to say, well, wait, let me think about it. Then you don't know it. You're drinking a cup of tea, having a good afternoon, and I say, listen, dude, what's prudence? You have to stop doing whatever you are doing, and you say, hey, listen, you know what prudence is? This is what prudence is. On your face, loser. Right? Awesome. So that's what we're going to do. We are going to prove everybody wrong that we don't know basic concepts. These are fundamental accounting assumptions. If you don't know these, what do you know? Nothing. Okay. Number one is going concern. Going concern is a business term that means that the company is going to be working. Going concern means that the company is assumed to be working for the foreseeable future. What's a foreseeable future? 1 year. So when I say the company does not have any going concern issues, it means the company doesn't have to worry about for 1 year. Understand? Then you have accruals. What are accruals? Just like I told you, there are certain expenses that you occur, but you don't pay for them until, I don't know, a month later, or a few days later, a weeks later. But there's another concept over here for accounting. Financial statements are prepared on accrual basis, meaning that the income and expenses are taken into account whenever they occur. So you earn the money on 1st January, you put it on 1st January. You don't wait for you to get it. It doesn't, okay, you're doing a business that is mostly based on getting the money in advance. But sometimes your customers will say, hey, can I pay you a week later? It can happen, it happens all the time. But when do you take into account your income? Whenever you earn it. Whenever you say, hey, this is your materials, take it, pay me in a couple of weeks' time. Hey, listen, you need to put that income on the day you gave your materials to that person. You get it or not my concern. You put that as an income. Receiving is your problem. I don't care about that. But you put that money as it is. The corresponding entry goes in receivables. Same thing for expenses. Electricity. What happens with electricity? You're using it. You don't know how much it's for, but hey, you're using it, so you need to accrue it. You need to put it in your accounts. Understand? And stuff like that. I mean, if you have any small issues or any problem with understanding these things, please do not hesitate to contact me. It's very important. It's vital for you to know about these 4 amazing things. Okay? Consistency. The transactions of a similar nature should be accounted in a consistent manner with each accounting period and from 1 year to the next. You need to be consistent. It's not like first time you say, hey, we will put a rental. We will put rental as accruals. We'll say debit the rental expense and credit accruals. The next time you say, hey, I don't like accruals. It just increases our liability. Why don't we just debit the rental and we credit, I don't know, cash? Okay, we're going to pay it a month later, but let's credit cash. You can't do that. You need to be consistent. Consistent with what? With your own accounting assumptions. Whatever you did in the beginning, you need to follow on with that. Understand? Plus, whatever example I gave you is wrong in itself, because if it's accrual, it will be accrual. Right? Finally, you have the prudence. The prudence is important. Prudence states the caution should be exercised when making accounting judgments. It is therefore that liabilities and losses should not be understated, and profits should not be overstated, and assets should not be overstated. Prudent concept means that you need to make judgments on a very, very objective manner. You need to be objective when you're making judgments. so that your liabilities and your losses are not understated. Nobody likes liabilities, nobody likes losses either. Everyone loves profits and assets, but don't do that. You need to be honest. That's the prudence concept. And these are the sample questions that I'll give you the answer to in our next video. So here you are, number one. It's a nice question. They are a little tricky, but you will have fun when you're doing it. And this is the accounting coefficient. Hey, I told you about accounting coefficients, right? But there you go. Accounting coefficients can be written down. I gave you a few examples, but here you have them more. And there's another accounting equation question. Like I told you, accounting equations are important. You need to know these. There's only one that you can change into a bazillion ideas, different ways, right? So you should know it. It's just do these questions and I'll give you the answers next week. Thank you so much for listening. If you have any further questions that you're not very sure of, if you have any problems with, please do not hesitate to contact me. And so here's me, Usman, signing off. I hope you guys have an awesome day. Thank you.